Okay, good morning. As I promised that I would be sending through the rest of the lesson. So here we are looking at where contract liabilities are fit into Ifrs 15. Someone might ask themselves, what is a contract liability? In this case, the customer has paid us, the amount that we said, what you owe us, or that, we already want. We would have sent out invoices, in other words, to say to the customer, you know what, you need to pay us this much. But at the end of the day, we have not yet delivered. So we still owe them the performance, and we don't owe them money. We have said to them, the customer, you owe us, and the customer came and then they paid us. Okay, what happens in this case? Simply because a customer has paid us, it does not mean that we can recognize a revenue. Hence, why contract liability is now introduced into the frame. So, two things from this definition, and both are examinable. Payment is not triggered for revenue. Receiving money will create a contract liability for you, and it is not revenue. I will repeat again. If you have not performed, because remember, we only recognize a revenue once we have performed. So if we have not yet performed, then the customer pays us, then what we have is not revenue. We're not going to recognize it under IFRS 15. We're not going to recognize it under revenue. But what this creates is a contract liability. And we all know that the moment when you have a contract liability, or when you have a liability account, therefore you need to credit because it has been created. It means that your contract liability is increasing. Again, a contract liability only arises when consideration is merely due. Like, for example, if you send them an uncancelable invoice for a service, then that is when you can say, you know what, the contract liability was triggered. So, a contract liability merely says, you know what, it mirrors a contract assets. So, if you have a contract asset, therefore you have performed, but you have not received money. The contract liability is the difference. You have paid me, or money is due, and I haven't performed. That is simply that. So in this way, yeah, welcome to the lesson of the day. Again, we look at the true contract balances and how we can be able to tell them apart, who is who and who is ahead in a state. When we have that our customer is the one who is ahead, they have paid us money, or an amount is due, and we have not performed, so that brings up a contract liability. It means that, you know what, in this case, we were just like, okay, you owe us money, or the customer saw it fit to say, you had to, no, let me pay those people ahead of time, and now we have not performed. Hence, why a contract liability is birthed. Now, there comes a time whereby we it's unconditional, right? Is your right to the money unconditional or conditional? What do we mean? Only the passage of time stands between you and the payment. That is when you have trade receivables. So sometimes money is due to you, but because of time, therefore you haven't received it as of yet. Because you remember, a trade receivable is an asset in nature. So it means that, you know what, this money we are owed, and we are just waiting for the right time so that this person can give us the money. And then when you have your contract assets, you would have performed, but you have not yet been paid. You would have performed, but you have not yet been paid. Therefore, that creates, you know what, you owe me money. You owe me money, and me, I have done my job. That's when you have a contract asset. But that is only if, you know what, you must still do something else. You must still deliver the rest of the contract. Or, there's certain thing, a certain period that you must still go through in this specific type of a contract. Hence why it will create a contract asset. But one thing is that when a trade receivable, you have done everything that you are supposed to do. Now you become unconditionally entitled to your money. They better pay you your money. All you want is for them to pay you that money that you were wearing. Okay. So there is a distinction that might end you or allow you to end mark. A receivable is measured and impaired under IFRS 9. A contract asset is also subjected to contract 9, expected credit loss model, but it is presented separately from receivables because the right to payment is not yet unconditional. So I want you to remember there being a condition for towards you getting your money. If there is a condition that exists, therefore it would be a different case. So be very careful when you are dealing with your contract assets, your contract liabilities, as well as your receivable. Contract assets and contract liabilities have a condition, being that who is ahead, whether it is you or is it the customer. Then your trade receivables, they have no condition on them. They stand and then they're like, you know what, we've arrived, we are done, and yeah, we just want our money. So I just want you guys to remember that. And then now, if a customer pays us in advance, as I said, yes, the money is going to come within our bank account, but it will raise up a liability called a contract liability. It means that even when you go and you create a journal, um, when you create a journal, it means that, okay, I have created a journal, therefore my bank grew, of course I received money, and then a liability arose, hence why you are going to have to debit your bank and then credit your contract liability. That is very important that you know at the end of the day. Another one, an amount becomes unconditionally due before performance. We haven't performed, but this amount is unconditionally due. Sometimes contracts like this exist, like you'll find that we have a non-considerable invoice that was raised before the entity performs. So we are still not going to recognize revenue. We will have a trade receivable and a contract liability, because remember the amount has become unconditionally due before performing. Maybe, who knows, maybe we are a carbon installing company and we need the money before we can perform. We need money to buy our material or order it from overseas before we can actually go and do the job. Hence why a trade receivables and a contract liability. And then we go, the performance obligation is satisfied. We have done our share of the job now. So now remember, we had received money in our bank account before, and we had a bank and a contract liability. Now we need to reverse that contract liability. Why? Because we have performed. So what you're going to do is you are going to debit your contract liability. You want to reverse it and then credit the revenue that comes along with it. So that is the reason why. So all in all, when you are looking at these journals, you need to always remember that condition and conditional, it is very important for you to remember. Another one is, there are contracts that happen over time. If the contract happens over time, therefore it introduced a financing component. The financing component being what? The interest. Remember, a financing component is introduced if a contract is being over time and they have provided that this contract at this much interest. So for each and every year that contract stays, then you are going to be recognizing the finance cost being the financing component. Your financing component, because it's an expense, you will always have to debit, and then as well as your contract liability. What it does is that it increases the amount of money these people owe you. So it's going to increase. So when we have money coming in, you are going to credit your contract liability. Performance, you debit your contract liability. Therefore, revenue never touches the bank account directly in a prepayment contract. So I want you guys to just remember that. So condition, unconditionally, when to debit, when to credit your contract liability. That is quite important, because your contract liability is going to play a very, very huge role. And then another one is that the customer pays, you deliver later. So this is a straightforward advance payment. So it says that, this worked example, Kalahari Kitchen has a 31st of December year end. On the 1st of November 2025, it entered into a contract to build and install custom cabinetry for a customer for 60,000. So we have the first date, me being the 1st of November. Then another thing that we know, that the year end is the 31st. Then the customer paid the full amount on the 1st of November. So we received money. We have received the money. So the carpentry was delivered and installed on the 15th of February 2026. Now we are being asked to prepare the journal entries and for the date of delivery and state the balance disclosed in a statement of financial position as at the 31st of December 2025. Okay, this is what we have established. We have established that through the customer paying us ahead of time, we have created a new account called a contract liability, and then we have created a contract liability. We have received the money, so there we are going to credit our contract liability. So because we received it ahead of time, then now we go as of the 31st of December, no journal existed. Why? Because nothing happened. The only other instance where we see something happening again is the 15th of January, whereby we actually deliver. Now that is when revenue is introduced into the picture. So if money is received in advance, we cannot recognize our bank with our revenue, but rather what happens, our bank is being affected by a contract liability. The second one is an example on partial performance, when you have performed partially or where an obligation is being satisfied in stages. Okay, here it says on the 1st of September 2025, Limpopo Lightning received 400,000 in advance for 2,000 identical light fittings at 200 Rand each. It delivered 1,400 fittings on the 12th of December 2025 and the remaining 600 on the 20th of January 2026. So I want you to look at this. So on the 1st of September 2025, we received 400,000 in advance for 200 identical light fittings at 200 each. But we only delivered 1,400 in December, and then the remainder we delivered in January. The year end is December 2025. Each fitting is a separate performance obligation satisfied on delivery. Okay. We initially received 400,000. We need to recognize the 400,000 that we received. We didn't perform on the day that we received. We received the money on the 1st of September. Our first delivery was in December. September, we are going to recognize the money that we received along with the contract liability that it created. Come December. In December now, we are only going to recognize the revenue for the 1,400 light fittings. That is what is going to happen. That is how much we are only recognizing. What this says to us is, out of the contract liability that we had initially recognized in September, as the 31st of December, the amount of the contract liability that is going to remain is going to be 120,000. Because it's already being recognized, you don't need to go and recognize it one more time. The moment the revenue that was the revenue recognized on the 12th of December, it is going to decrease that amount because that contract liability was debited with 280,000. So that has been addressed. So where a customer pays well in advance of delivery, the entity is in a substance being financed by the customer. Let's repeat again. Where a customer pays well in advance of delivery, the entity is a substance being financed by the customer. If the period between payment and transfer is more than 1 year, Ifrs 15 requires the transaction price to be adjusted for the time value of money. We have talked about the time value of money. The entity accrues interest onto the contract liability, and the revenue eventually recognized is larger than the original money that we received. So if we are going to look at another worked example, As of the 1st of January 2025, High Volt Machinery received 500,000 from a customer for a specialized machine to be delivered on the 31st of December 2026. The contract contains a significant financing component and the appropriate discount rate is 8% per annum. The year end is the 31st of December. The first thing to remember, we received the money in advance. Okay. Because the customer pays 2 years before delivery, the entity has received a financing benefit. Interest is accredited onto the contract liability at 8% and recognized as a financing cost in profit or loss. What do we mean? The consideration that we actually received was 500,000. But because there is a financing component, then we have an 8% in the first year. Again, we are going to say your 500,000 multiplied by the 8%, you get the amount. From there, the balance is going to carry down. It's going to roll forward in being said in essence. Then that being rolled forward, you are going to use that actual balance, the consideration received plus your interest to get so that you can be able to calculate the interest for the second year, which is 2026. Then at the end of the day, when we now go and receive, we are going to say we received this much of money, hence the financing component. It falls on the owners of the business to actually recognize that much, because remember, a contract liability had been formed. So this happens when there is more than one performance obligation. I just want you guys to remember that. So we are going to have a contract liability, and then we are going to credit it. That is the first year. And then as of December, we recognize the first interest. The following year, December again, we recognize the second. Once we have delivered, we can recognize the actual amount of money that we received. The actual amount of money that we received plus the interest over the 2 years. Then you recognize your revenue. Okay. Then we go, what happens now if your contract comes with a non-refundable upfront fees? So, Umhlanga Fitness charges a non-refundable joining fee of 1,200 and a membership fee of 400 per month for a 12-month contract. Yeah, you know what? Gym save us. The joining fee does not transfer any distinct goods or services to the member. It merely gives access to the gym, which is the service already being paid for monthly. A member joined on the 1st of January 2026 and paid the joining fee that day. Calculate the monthly revenue and prepare the journal entries for January 2026. Okay. Remember that the joining fee does not provide any distinct service. It just forms part of the transaction price for the 12 months of the access to the gym. So your joining fee is 1,200 rand. Your monthly membership fees is going to be 400 multiplied by 12 for each and every year that you'll become a member. But your total transaction price at the end of the day will be 6,000. So each and every month as we move on, we will be recognizing a revenue of 500 rand, because you remember it just forms part of your transaction fee. So you cannot ignore it. Then the joining fee, we are going to recognize it as your bank against your contract liability. The joining fee is an advance payment for future services and not for revenue. And then now we go each and every month when we go and we do journals. Right? Because every month as they pay, then we need to recognize. We are going to recognize revenue of 500,000. Why? We are going to receive the monthly membership subscription in our bank account of 400 rand. Each and every month that the customer remains a member in the gym, we will keep on pushing 100 rand of the contract liability into the debit so that it can reduce the initial contract liability. Remember, it is for a service. So hence why it keeps being pushed in for each and every month that the customer is a member of. So throughout and throughout, that is what we're going to have. We have looked at your contract receivables, we have looked at your contract assets, we have also looked at your contract liabilities. Your trade receivables, you know that if you were to go into your financial statements, your trade receivables would be under your current assets. Contract assets as well will go under your assets, while your contract liabilities go under your contract liabilities. So now, if they were to say to us that, you know what, do an illustrative disclosure note, we would look at they want us to do 2 years projection, then we would have to show exactly how much we are going to recognize under our contract assets and every single thing. And then, guys, when you are busy practicing, you will find that we have a practice question at the end of this, and then it also has its solution advanced to it. So, guys, just try and do the questions before you can go and attempt. And this side is just a summary of everything that we have covered. So if the question says the customer paid a deposit or paid in advance, you know you have a contract liability. A non-cancelable invoice was raised before performance, we have a receivable plus your contract liability. The goods were delivered, the service was performed, then now revenue comes into the picture. Now work is done, but payment depends on further performance. Then you have a contract asset. How can I put that so that I can clarify it, since I didn't have an example for it? Like for example, maybe let's say that you were required to build a build like your whole project was building, and they say that you can only receive your money once an inspection has been done. So that is a requirement before you can actually receive your revenue. So hence a contract asset. Then if your payment is now unconditional, trade receivable. The advance is more than a year before delivery, so there's going to be a financing component. But be careful not to make up percentages. They need to have given you the financing components. The financing components, what do we call this, in the interest rate, so that you can be able to calculate. Now I just want to go to the test pack that we have. I want us to just address a few things on that. And yeah, I want us to address a few things on example number 2, because I think people might have questions on what is going on the second one, because it is a bit different from the first one. Okay, the second one says we need to calculate the gross profit recognized for the year and the contract asset or contract liability at the 31st of December 2025, using each of the following methods to measure progress towards satisfying the performance obligation. The output method based on time elapsed, the input method based on the coast to coast, and clearly indicate in each case whether the balance is a contract asset or a contract liability, and show all workings and round to the nearest. So that is what we are going to just look at. The output method based on time elapsed, and as well as the input method based on the cost incurred. So the output method, firstly, the output method recognizes the revenue over time by directly measuring the value of goods or services transferred to a customer compared to the total promised under the contract. Progress is tracked using direct results like units delivered, milestones reached, or surveys of work completed, rather than internal cost. What do we mean by this? We are saying to you that we need to see which milestones you have hit while you have been on this. How many units have you delivered to us? How much time has elapsed? In this case, hence why we are speaking about the time elapsed. If you go back into your question, you will realize that they gave you total time elapsed to 31st of December 2025. Guys, they might not give it to you. I'm gonna show you how you would determine this, I don't know how fast I am able to type, but yes, we are going to try. We are going to try. We are going. Okay. So let's look at it. From the, it says that Build Red Construction Ltd entered into a non-cancelable contract on the 1st of March. 1 March, 1 March 1 3 2025. Then we're going to calculate that to the 31st of December 2025. Here you are going to count the months. March, April, May, June, July, August, September, October, November, December. We have 10 months. That is how you are going to calculate. In this financial year of 2025, we had 10 months. Then we go into the following year. The following year, we are going to start already being busy. So the following year, it's going to be the 1st of January, the 1st of Jan 2026 to the 31st of December 2026. That is how you are going to calculate. And now we go, and now the third year. The third year, it's going to be the 1st of Jan until when the contract is meant to elapse, which is the 28th of February 2027 to the 28th of Feb 2027. So now you know, okay, here now I have 2 months. So if it is the time elapsed, how much time has went away? So now in 2025, the amount of time that has went out is actually 10 months. That is how we are going to calculate, and that is how we are going to actually recognize the revenue. So all in all, you know, there are certain figures like this. The total budgeted contract cost, that is how much we are hoping to spend as our contract cost on the project. And then in 2025, that is how much we actually spent. The expected amount of money is 2.4 million. The amounts invoiced to the customer is this much, so we invoice the customer that much. They didn't say if it's uncancelable or what. And then how much we actually received from the customer is 1.1. So the question that we need to look at here is, how much work did we actually put in? Hence the question. And then the next one that we are going to look at is the input method. So we are doing the output method based on the time that has elapsed, and the input method based on the cost incurred. So your cost to cost that you have actually incurred. Yeah, apologies, guys. I'm still trying to figure out how to do recordings. Hopefully, with time, they will get better, and I will be able to write more. And yeah, I'm trying to perfect the art of doing this. And then now we go on. So I want you guys to remember, we talked about the months within the 2025 period. Now, the total amount of time for the contract is 24 months. Remember, from the 1st of March 2025 to the 28th of February 2027, that is the full 24 months. Now we need to know. They said that we might supposed to use the output method based on the time elapsed. Okay, how are we going to do this? The time elapsed is 10 months out of the 24. You can either use it as that or convert that to percentages, right? 10 over 24 will give you a percentage. So you can simply say 10 months, 10 divided by 24 multiplied by 100. Then you're going to get a percentage. And then we go. We are going to use that in order for us to check how much revenue we can actually recognize. Here we are recognizing revenue based on how many months we have actually spent on the project. I will repeat. We are recognizing revenue based on the months we have spent on the project, or based on how much work we have done out of the total work we are supposed to do. Okay. Now we are using the total revenue because remember, at the end of the contract, how much do we expect to receive? That is 2.4 million. So when an example like this comes in, always break it down in this way. How much have I put in? And how much money at the end am I supposed to receive? Another one, how much did I spend? How much was my cost of sales? Are we together? So when you have spent that, like you need to know, you are only going to base that on the amount of time you have spent on the project. That will allow you to assess how much gross profit or how much loss have you made. Now, if you look at the revenue that we are supposed to generate with the amount of money or amount of time we have spent on the project versus the cost, then we have a profit. That is why it happens. Now we want to go and recognize whether we have a contract asset or a contract liability. Okay, there is an amount of money that we actually received versus the amount of money that we actually invoiced to them. The amount of money that we invoiced to them, we said to them, this is how much we feel like is due to us. Remember, the amount of money needs to be due to you, or you feel like it's due to you. We invoice them 1.3. I will repeat that again. We invoice them. That is not us saying that this is the amount of money that we received. We invoice them 1,300. If we were to go and we record, right, we would say, if the question had asked us to do a channel, right, we would go and say our bank 1,100 rand. Our bank 1,100. Revenue recognized 1,000,008. And then now we would check that, you know what, from this amount of money probably we have amount that is missing, or we would recognize first the bank along with your contract liability, and then after that recognize your contract liability with your revenue that you would have recognized once the project is done. But we have a contract liability there based on how much we have invoiced them. Then now we go to the input method. In our input method, what we are using is cost to cost, money to man. Cost to cost, money to man. Here, we are going to look at the budgeted amount and the actually spent amount. The budgeted amount to the actually spent amount. So this is how much we budgeted. We budgeted 1.8, but we actually spent 1,050. That is about 58.33% of how much we had, budgeted. That is how much we've spent in this 10 months. We are going to recognize the revenue based on 58.33% because that is actually how much we have spent towards this project. Therefore, we deserve to receive how much? 1.3. Then we are going to use the cost of sales of the cost incurred to date, which is 1,500. Then our gross profit will be that. So the difference is just that the other one, right, we are focusing on the time that has elapsed in the project, versus in this one we are actually focusing on the amount of money that we have actually put into the project. And then if you are using this method, you will realize that the recognized revenue is greater than the amount invoiced to date. That is why we have a what? A contract asset. That is why we have a contract asset. So in this method, you're not asked to prepare to do journals. All that you are being asked in this is that we need to calculate the gross profit for the year. And yeah, with that being said, guys, I don't know if you guys feel there is something that still needs to be addressed, or there are a few minor missing things. I will make myself available throughout the day so that I am able to assist you guys. And you guys, I'm wishing you all the best in this upcoming test.